Welcome to Balance Sheets. This is Module 2. We're continuing on with the financial statements. The first one just introduced you to all the financial statements, and in this one we're going to look at the balance sheet. So the balance sheet was one of the 4 different statements, and this is what we're going to focus on. Remember, a balance sheet is at a point in time, so you're having a beginning balance sheet and an ending balance sheet. These would be the last day of the last year, the last day of this current year, and so exactly 1 year apart. The income statement, cash flow, and statement of owner's equity all happen within what happens between the beginning and ending. You're using information from the beginning and the ending to actually create these statements, so it's important that they all correspond to that calendar year. And again, it's at a point in time, and balance sheet's going to show what the firm owns, which is the assets, what it owes to other people, obligations, liabilities, and then what is left over, the difference between those two, is the owner's equity or the wealth. It's important to complete those balance sheets at the same time each year. Usually that's December 31st, so that we have an accurate, something that we can compare from year to year, and it's accurate, and it also helps in preparation for the other statements. So here's a graphical representation. We have assets, and they're going to be exactly equal to the liabilities and owner's equity. And you can also think of the owner's equity as being the assets minus the part that is the liabilities. And so here's your formula. That's a very basic formula in accounting. And so something like this can kind of show you really what part are liabilities and what part is owner's equity. Let's add a little more detail into this. So each section, the assets and liabilities, we have a current section and a non-current section. Current assets are going to be things that you would normally use within the 1 year. Cash, supplies, crops that you've produced that you're going to sell, feeder livestock or your calves that you'd be selling within 1 year. You add all those up, and that's your total current assets. Non-current assets are assets that you would normally have around for more than 1 year, and they also, rather than being something you're in the business of buying and selling, you're really using them to produce other assets that you'd buy and sell. So for a tractor, you're not in the business of buying and selling tractors, but you're using tractors to grow your crops that you would then sell. So non-current assets are going to include the breeding livestock, machinery and equipment, buildings, improvements, land, things like that. We'd add up all the non-current assets. That's the total non-current assets. Then your total business assets are the total current plus the total non-current. Similar for liabilities over here. Current liabilities are going to be obligations that you would owe within the next year. These would include accounts payable, like bills for your twine, your feed that you would owe right now. Accrued property tax that you have to pay. It would include interest that you've accrued on your debt, and principal payments that you need to pay within the next 12 months. Non-current liabilities are obligations that you owe to somebody, but they're going to be paid and become due after the next 12 months. And so your mortgages, long-term debt, the principal payments that are due in later years would be here. Your total liabilities are your total current liabilities plus non-current. Your wealth is the difference between your assets and liabilities, but it's also, we can break it down into where did it come from. And there's really 3 sources here. Retained earnings are profit that you made in the business and you retained in the business. You didn't draw it back out. Contributed capital is money that the owners invested into the business and have not drawn it back out. And valuation equity is wealth that you've gained through the value of your assets increasing. So you may have some assets over here like land that have increased in value, and so that gives you wealth, and that's valuation equity. So your total owner's equity is the 3 of these added together, and then total liabilities plus owner's equity have to equal total assets. And that again is our formula. So looking at the book, there's a lot of different schedules and details in the book. We will not use those, but a lot of the information on the balance sheet is helpful. Those schedules were set up to be helpful for farmers to fill out a balance sheet when they were doing it by hand. we are not going to list real estate. We're going to list buildings and improvement and land. I'd like to break those two out. And let's go ahead and look at what our balance sheet's going to look like when you finish it. So here's, this is the handout for the homework. And I'm giving you the key because as you go through and build that homework, I think it's more important to have something there so you know you're building the file correctly, so that you have a Excel file that you can use, rather than me trying to really, I'm not looking for the actual answer, I'm looking for the process. So here's your balance sheet. Instead of having the assets on one side and liabilities and owner's equity, to fit it on our page, we have assets at the top and then liabilities and owner's equity here at the bottom of the page. Each column going across is a single year's balance sheet. So the balance sheet for, and this is one that's based on homework modules 1 to 6, and it's as of December 31st, 2010 and 2011. And then the other thing that we have here is some of them are cost-based, and we'll get into how your assets are valued, and some of them are market-based, and then we can just do it for just the farm, or we can add the personal assets in there. But looking down through here, I have current assets, just like I said, cash, accounts receivable, money that somebody owes you, your calves, crops and grain inventory, prepaid expenses, supplies, and a total. You have non-current assets, your breeding livestock, machinery and equipment, buildings and improvement, land, and total non-current assets. Then your total assets are the total current assets plus the total non-current assets. If you want to have personal assets, we're just going to keep them down there at the bottom so you can see total assets with personal, but we're keeping them segregated so we can really look at standalone business financial statements. Then let's look at the liabilities and owner's equity. You have the current liabilities, accounts payable, bills that are due in the next 12 months that you already owe. Notes payable would be like your operating loan because that's going to be due within the next 12 months. Accrued interest on your debt. Current portion term debt is the current part of the mortgage that'll be due within the next 12 months. Taxes, and so we add up all of these total current liabilities here, non-current liabilities, mortgages and loans that are due more than 1 year into the future, total non-current liabilities. We'll talk about this deferred tax in the next section. And then we have total liabilities are the total current plus the total non-current. There is a place over here to add in the personal liabilities, so if we add in personal assets, we have to add in personal liabilities here. But again, our statements can be business ones, just stand alone, even though we've included personal. And then down here are retained earnings and our owner's equity. Retained earnings, contributed capital, personal net worth, so there's a place to add that in. And then valuation equity, the net worth from appreciation on your assets. So all of those would add up to total owner's equity. We're adding the liabilities plus the owner's equity, and then div here is just my little check to say, is the total assets up here $633,938? Does that equal the liabilities owner's equity? In this case, they are exactly the same, so the difference is 0. So this is just, normally I wouldn't print this out, but this is just your little check to make sure that the statements are doing what you think that they're supposed to be. So that was our introduction to financial statements.